great having the opportunity to comment on Ed's presentation. Very rich, interesting, stimulating, lots of insights as usual. And we invited prominent representatives from different parts of the financial world. So we have Professor Stephen Sheffer from the London Business School, a prominent academic, was studied in-depth issues around default risk, relationship with macroeconomic factors, and many similar issues. And Steve will make comments on the default rates evolution and also on the capital regulation, with particular focus on the banking sector and the interaction also with central banks' monetary policies. Then we have Murad Kudri, is the CEO of City of London Capital, a new startup bank in the UK, but also was a former treasurer at RBS. Is a very well-known practitioner, risk management, also with an academic background. Is a visiting professor at the University of Kent. Has published extensively on the field of risk management, market credit, and everything. Then we also have Piotr Chemleski, who's the Chief Risk Officer of Fulcrum Asset Management, and it's great having also Piotr to have a standpoint from the asset management industry that is obviously has been impacted by the negative interest rates maybe more than other sectors. And also with Ed, who's going to share views on his discussion points, but particularly we would like to try to understand what are the new drivers in credit markets, and there are many. So many forces. These forces are interacting in a very strange, non-linear way, and the outcome of this interaction is a lot of uncertainty at the moment. So it's very difficult to predict the evolution of default rates, recovery rate, interaction with the macro factors when you have such significant external factors like central bank's monetary policy. Ed mentioned today the decrease of yields, the difference between yields on the high yield bonds in the US and Europe, the inversion, yields in Europe are lower than the US because the QE in Europe has been much more aggressive than in other countries and is still continuing. So these are the issues that we are going to share with among us, but also particularly with you, and we'll open up the floors to your questions because it is an opportunity also to have your views on it and understanding what is going to happen in the future with an additional factor that today is also the US election outcome, which definitely is going to complicate things. It will also have an impact on interest rate, particularly, and other macro factors. I think we start with a first round of comments. Let's say 3 to 5 minutes, each of you, your views on Ed's presentation. So what do you think, what are the main points, and your comments on his main takeaways on the credit benign cycle and the postponing of the cycle for so many years. So Steve.
Fine, good morning everyone. I'd like to just make a few comments about the way we interpret default rates and what we can learn from the historical, from history. Because I think there's a danger that we overinterpret, right, what they have to tell us, unless we measure these things over really unreasonably long periods. Let me give you kind of just some numbers. Okay, the problem is particularly serious for investment grade, and there are two problems. One is that the default in most of the market, all right, over short periods is a relatively rare event, not in very high yield, but it's a relatively rare event. And secondly, and most particularly, that the correlation between corporate asset values, okay, and so think of that just in terms of ordinary equity correlation, if you like, right? So the correlation between corporate asset values means that the distribution of the default rate has an enormously long right tail. Right? Now, those of you who in risk management will be familiar with this from thinking about the distribution of losses in a portfolio and whatever. But actually, precisely the same distribution applies to historical average default rates, or almost the same distribution. So let me give you just one example. If you take a default rate of about 4%, and that would apply to, let's say, triple B over about 10 years, or it would apply to some of Ed's bonds over about a year, all right? The distribution of a kind of 10-year average, right? Default rate of where the individual default rate is 4% over, let's say, 10 years. One drawing from that distribution has a 95% confidence interval that goes between about 0.5% and 13.5%. So in numbers, some of them published by one of your competitors that I'm more familiar with, right? Where that is the average triple B default rate over 10 years, measured, let's say, so the average 10-year default rate, but measured as the average over, let's say, 30 years, okay?
Steve, that's not an annual default rate.
Sorry?
That's a cumulative.
That's a cumulative default rate.
Make
Default rate.
that clear.
Okay? The single number that you see printed on the page, you should think of as a drawing from a distribution that has those kind of limits that I've just described, about 0.5% to 13.5%, right? And it's incredibly wide because of asset. When you have a really bad drawdown on the market, you're going to get terrifically high default rates. That's going to happen rarely. But the possibility of that event has an important impact on the mean. So most of the time, you will observe default rates, okay, that are below the mean, right? And I think there's a danger, right, that we interpret history sort of too benignly, that because we observe default rates that are most of the time below the mean, right, we mistake what the mean is, because we don't just observe those very bad outcomes very often, okay? So this is just a bit of a sort of something to bear in mind when we look at these default rates, right? And we average them. These things are very much the product of sort of single draws from a particular history, and there are many other possible histories we could have had that would have given you very, very similar, very different outcomes.
So statistical properties of default rate distributions are very relevant, right?
Yeah.
And they're far away from being normal, right?
That's right.
In many cases,
the bottom line, if I had to make a guess, okay, I would say that the kind of numbers that people talk about as the underlying default rates are typically too low, right? That people are not, the market, I think, actually in pricing stuff, actually does take into account, okay, pretty well what the mean is, but in conversation when we look at these numbers, okay, a lot of the time we're using numbers that are probably too low.
Any comment from you, Ed, anyway, on this statistical property and adjustment for volatility?
First of all, default rates are, I admit, a challenging statistic for many ways. First of all, there are many different ways of measuring it. Dollar value, number of issuers, medians versus means. It is important to understand that when we talk about a 2 or 3 standard deviation year relative to the mean, that does have meaning with respect to the tail distribution, because a standard deviation relative to a median doesn't have the same importance. So, and the second thing is, our default rates are weighted by the amount outstanding in the market. So it's a weighted mean, which I think is more meaningful than an arithmetic mean over 40 years when the market was tiny, for example. But Steve brings up a very important point, and that is, be careful about using one metric, whether it be the mean or median or whatever it is. So we publish them all, and we let the risk manager decide which is the important one: the mean, the median, the standard deviation, the weighted mean, the unweighted mean, the arithmetic mean. And if you think that some are more important than others, that's what you should use. But we let the market determine it rather than tell you what you should use. but it is tricky, and not only is it tricky to measure it, it's tricky to forecast it. So what models you use to forecast has to be relative to some expectation. And if the market expects, for example, a default rate of, like it did in 2009, of 18%, they're talking about 18% of the amount outstanding at the beginning of 2009. And if it ends up being 10%, I've always observed that that has incredible importance to the performance in the market that year. So keep in mind, even though it's tricky, if you have a standard way and a reference point in your forecast versus expectations, that's going to be very important to the market, regardless of the tail risk that risk managers look at.
Murad, any?
Sorry if that makes it more murky, but someone once said, never forecast. But if you do, never put it in writing. But if you do it frequently.
So you can adjust
And
it.
so that's another element about expectations versus actual. If you keep changing your forecast, then it's hard to really understand how the market's going to react, as opposed to what people decided upon when they decided to buy or not the securities at the beginning of the year. Most don't sell, on a daily or weekly basis.
If you adjust it more frequently, you will never be wrong, right? Which is
I
a
was
really-
just
that's a
going
good
to
point.
say,
That's a good point.
if you forecast
You'll never
frequently,
be
you won't
wrong.
prove it
You'll never
wrong.
be wrong. So, Murad, what's your view on
Thank you, Cristiano.
liquidity markets?
Thank you. Good morning, everybody. My privilege to be here. And in fact, before I answer Cristiano's question, I should just say, if you told me I would be sharing a panel with Professor Altman even a few years back, I would have said no. It's a bit like a bass guitarist being told he's going to share studio time with Paul McCartney. So it's a great pleasure to be here. Thank you for the invitation. Just a comment to on the slides on the presentation. I know with interest the increase in the high yield issuance. The volumes going back. So we've seen the cycle going still on an upward trajectory by the graphs. One shouldn't be surprised because, of course, we've been operating in a very low interest rate environment, and indeed in the Eurozone, a negative rates environment. And that because it's been here for such a long time now, what was important and necessary in 2009, we're now in 2016, it's getting into quite a long period of this environment, means the search for yield from a fund manager's perspective, something which I don't do, becomes more tricky. So where does one get the yield? And that means one has to extend along the risk-reward curve. At the same time, for various regulatory reasons, whether you're including for banks as well, one has to hold a certain amount of risk-free securities. And at the moment, even for countries outside of the Eurozone, as well as in the Eurozone, most of them, that's paying you a negative yield as well. So we've got a situation whereby, it's a paradoxical situation where monetary policy that central bankers on both sides of the Atlantic are following, and indeed in Japan are following, are creating contradictory conditions. And if I present from the bank's point of view, let's just consider what we've got here. So it's most extreme in the Eurozone where it is negative, and it's negative out to some quite a fair bit along the term structure. Okay, it's not just, the 30-day T-bill is at negative. You're buying sovereign credits out to the medium term, and it's negative. And for regulatory purposes, again, let's look at from the banks then. I've got, one has to hold liquidity. So we've got a paradoxical situation whereby central banks are pursuing or continuing to pursue monetary policy on the QE side as well as on negative rates that prevent banks from actually generating net interest income. I'll just go into that in a second, which means they can't strengthen their balance sheets. But at the same time, for regulatory purposes, they are required to strengthen their balance sheets with more capital and liquidity. At the same time, they are prevented, or it's more difficult to generate net interest income because of the negative rates environment and having to charge corporate depositors for substantial sums. But then they have to be compliant for liquidity, Basel III liquidity. So you've got one arm of the central bank providing, take the ECB, 3 and 4 year cheap money, okay, so to enable them to be compliant with Basel III liquidity, because lots of banks in the Eurozone, it's not a published statistic, but you know, I'd bet a tray of cream cakes, there's quite a few banks in the Eurozone that wouldn't be compliant for liquidity coverage ratio or more tellingly net stable funding ratio requirements without the ECB's help. On the other hand, you've got them having to pay 40 basis points for depositing cash. Now, what's the ostensible reason for having that? Oh, we want you to lend the money, we don't have to park it with us. But of course, corporates and institutions are long cash, so we'll have to charge them. So it's difficult for me to generate a relationship that requires me to charge for depositors, institutions are now paying in the Eurozone, at the same time lend money at a rate. So I'm being prevented as a bank from strengthening my balance sheet, and I'm required to strengthen it in order to meet Basel III capital and liquidity requirements. So we've got a situation now that is becoming quite acute because it's been in place for a long time now. That means one hand of monetary policy, one hand of the central bank action is preventing the banks from strengthening balance sheets, while the other hand is requiring them to strengthen balance sheets. It's paradoxical. And what is the best way to, if one wants to encourage corporates, to encourage business, to encourage lending growth, you know, the best way to enable that is to have a bank with a strong balance sheet that is enabled to lend money. On the other hand, if you're preventing it from doing that, indirectly through monetary policy, it becomes this vicious circle. So we've got that situation that I don't think is in any way helping at the macro level of the economic policy making at the time, currently, and I don't see any light at the end of the tunnel. I don't see central banks other than the US saying, okay, you know, it's time to talk about unwinding QE and negative rates policy. And then so with respect to Professor Altman's slides, I'd noticed the increase in issuance amongst lower rated issuers, from lower rated issuers, you know, high yield, etc. And that's, one will keep seeing that because, of course, if I'm a fund manager or a bank asset manager or a liquidity portfolio manager who is required to generate certain returns, I'm going to have to look at in sub-investment grade or along the term structure, because anything out to 10 years in the investment grade isn't paying me anything like a decent return because the term structure is so flat or negative. And I wanted to point out amongst your colleague Paul Sheard's paper, the S&P paper recently from August, which said that, okay, by itself, the base rate of the central bank isn't seen as something that the rest of the, you know, the consumer community, corporates and individuals, will necessarily be impacted by the base rate. But of course, the base rate is the baseline for the rest of the term structure. So whether it's the risk-free term structure, the government rates, or the risky term structure, when you go into LIBOR, swap rates, actually not risky anymore, but corporate lending term structure. So if that is negative, the entire term structure struggles to get into positive territory until I get into the 10-year or beyond, and I'm left with a paradoxical situation which makes the job of both fund managers and bankers more so that much more difficult and that much more problematic to get into a strengthened balance sheet situation. So I hope that addresses both your points.
Yeah, no, that's exactly.
Professor Altman's paper, but his presentation, sorry, and also this general macroeconomic conditions that we have to work to now.
I think we touch upon a very important point, which is the fact that central banks are essentially controlling both the short end and the long end of the yield curve, right? Which is in a way super surprising, right? They should control the short end, not the long end, right?
Absolutely.
And that's what is causing the issue. But also, you mentioned a very important point on when you talk about the challenges of banks on the liability side, started to charge depositor. And anyway, this links properly with Piotr on the asset management side. Anyway, if banks are starting to charge depositors, could there be a sort of reallocation of assets from banks to asset managers, depositor moving, or what's the
well, that would be one would expect that. I mean, it's been for a few years now, ever since the ECB introduced negative rates. But I know some of my chums are working in say corporate trust, for example. So the institutions are long cash, so not just bank and non-bank FI institutions, but also straight corporates. They're long cash in the Eurozone, the UK, US as well. Now, and one has to pass the charge on. So 20 basis points to currently 40 basis points. You know, why would I want to do that? If I'm not, unlike say a fund manager that may be required to hold a certain amount of assets in risk-free securities, if I'm like a straight corporate, I don't have a regulatory reason to hold assets in any particular place. I can put them where I want. I'm not going to want to pay pay a bank 40 basis points or 20 basis points for the privilege of taking my cash. So of course, I would look for other, and even money market funds are struggling, depending on which asset valuation approach you use, both sides of the Atlantic, are struggling to maintain that the valuation that says it's always going to be par. So if I don't want to commit to long term, I've got short term operational cash requirements, I don't want to pay negative rates, why would one? And the money market funds are struggling to guarantee that the par value, then of course I'm looking at reallocating elsewhere, which may or may not be a good thing.
May not be a good thing, exactly. So Piotr, in a way, your challenges and how do you see your industry, the asset manager, and in terms of credit as an asset class, and in a way, the impact of default rates, the evolution, how do you see this kind of current situation?
Thank you, thanks for having me. First of all, I have to make a disclaimer. Whatever I'm going to say is going to be my personal view, not the firm view. Second, I think it's a very interesting time for asset managers. It's a difficult market environment with low interest rates. It's a difficult market environment with interest rate curves which are managed by central banks, by monetary policy. We've had a long period of time when we were subject to this management of interest rates all the way out to perhaps as far as 10 years. In Japan, there is an explicit target for the 10-year rate. In Europe, it's an implicit target ultimately, but central banks' QE programs are pushing the longer-term rates down. Against this background, we do have a development recently, which is quite interesting. It's the development of the lot of talk about a change of balance between the fiscal policy and the monetary policy. We've heard that first in Japan. We heard that now in the US. After the election this morning, there was a telltale sign. The US yield curve has steepened, and at the same time, the dollar went down slightly. These were small moves relative to what was expected, but ultimately, given the programs of both candidates, one expected a much more active, much more aggressive fiscal policy. This will probably result in central banks having some room to actually be less aggressive on the monetary policy. Yield curve will possibly end up being much steeper, perhaps better environment for asset managers, perhaps better environment for banks ultimately. It might flow through Europe given how markets are connected, but there could be a long period when the two markets or the three markets, the major markets worldwide, interest rate markets and credit markets are disconnected. Following on Ed's presentation and the comment that we are in overtime now due to the monetary policy, I wonder, maybe I can bounce back the question at Ed, what would be your view on the potential results of fiscal policy, more accommodative fiscal policy on credit markets as such?
Yeah, by the way, that's the optimistic outlook.
Yes,
where,
optimistic.
where fiscal policy finally kicks in and relieves the pressure on monetary policy, which has been shouldering the burden, if you will, to keep markets benign for quite a long time. So I'm not a politician. I do think that an area that is becoming much more attractive to analyze from an academic standpoint and hopefully for the world standpoint is infrastructure finance and the investment in the infrastructure of countries. And that, if that kicks in the way we need to have it, that would provide a stimulus to the financial markets, to equity markets in particular, but also to relieve the pressure on monetary policy. I'm not convinced that it really baffles me that companies have raised and countries have raised so much debt capital without investment following. That's not typically what happens in economics. So that means either a new paradigm with respect to expected growth, and therefore less aggression on investment, or that it provides investors in this low interest rate environment with the opportunity to earn high returns only in lower quality assets. Let me make one comment on that. My fear is, and this is not on the fiscal policy, but my fear is that this quest for yield, this low interest rate environment, encourages risk-taking. And if it encourages risk-taking, that means a buildup in both investments in and the issuance of risky debt. And people are, financial markets are usually creatures of short-term analysis, and they look at the benign situation, which, by the way, I didn't point out. At the end of this year, the benign cycle will be the longest in the history of our markets, admittedly 40 years. There's never been a benign cycle longer than 7 years. At the end of this year, it will be 7 years of low default rates, high recoveries, high liquidity, and low spreads. So we've never had a long. This encourages risk-taking. And the only thing to stop that happening will be, I believe, the Fed and others raising interest rates, making debt more costly, and reducing the quest for yield. So I see the real danger in monetary policy on the part of central banks continuing for so long at this benign stage. But it's almost like they're paranoid about promoting down cycles. Just take the US, for example. Every time there's a change in the jobs numbers, the Fed changes. They're not looking beyond 1 month of data. They're so, I mean, they won't admit it. I'm talking about the Fed officials. But just take a look at the press, and there were statements on the part of the Fed officials. I'm not sure what happens as much in China and Japan, but just look at the change in perceptions about raising interest rates with a slight shift from, say, higher to lower in the jobs market in the US. To me, that is, sure, it's human, but that's a real danger to keeping this very high. So maybe you're right. The only way to give them being the central banks, more backbone to raise interest rates is more accommodative fiscal policy.
I think Murad has a comment on that. Right?
Well, I just wanted to, you mentioned the comment on the Fed, absolutely spot on. The whole point of monetary policy is it's meant to be, if not necessarily long term, at least medium term. It's pretty unarguable that a change in base rates, or it wouldn't impact immediately. It would take some time to feed through, even in your statistics, let alone consumer behaviour. And yet, so you mentioned the Fed. I mean, I'm dismayed at what I see at the Bank of England. It seems to be responding just to last month's statistics, whether it's GDP or unemployment or something like that. And to suggest, as the bank has informally or implicitly, that the cut from 50 to 25 basis points in August is why, everyone generally, the markets and consumers, were relaxed after Brexit when they're expecting everything to tank. It's a bit insulting actually to our intelligence. Because I don't think a 25 basis point cut in base rates, suddenly means people go out and start spending a load of cash a month later, and suddenly it's in our GDP numbers for the third quarter. So I wish, you mentioned the Fed, I wish other central banks took more of the long-term view and realised that, okay, having had all this accommodative monetary policy, it's going to now create more pain than it's curing from 7-8 years ago. And they need to have the boldness to move first. You use the word paranoia. I think they're paranoid about if we do raise rates by even a minuscule amount, what if something tanks? We have to realise that, negative rates are not normal. If I charge you to deposit with me, you'd think, well, that means if I borrow from you, you should pay me, right? Otherwise, why would I have a relationship? It's not normal. So we can't have it for years and years and years. And this paranoia is what infects it. And I totally agreed with both of you and Piotr on if fiscal policy was a bit more aggressive in terms of cutting public expenditure or reducing, for example, social security payments, then we would have the central banks could have a reason to say, okay, we can maybe start being a bit more aggressive. But of course, that's not going to happen. That's why I said it was very optimistic on Piotr's point, because I can't see governments doing anything in any material amount with respect to cutting public expenditure. So therefore, we can't wait for that, otherwise for monetary policy to change, and we could end up going into a vicious downward spiral that, which is more scary than, that it looks like now. So that's my worry, and I just wanted to comment on that, is there need to be a bit more forward thinking, a bit more long-term view, or at least medium-term view.
I think it's a good point. I would like to change topic, which is related in a way on the situation of the liquidity in the credit market, right? I think this is extremely relevant, and negative interest rates have an impact on the liquidity, lots of liquidity in the market, but not necessarily in the credit market. We saw at the beginning of the year the crisis of the Third Avenue Fund in the yield bonds in the United States in January, and liquidity is still in a way is still not there, right? So I don't know what's your view, particularly Piotr. I know you work obviously as an asset manager, and the liquidity is not there because there are several reasons why. Particularly is regulation, fundamentally the trading book, the banks are in a way it's much more expensive for them to be in the market as market makers, and is this one of the reasons, or how do you see the liquidity in the credit market, particularly these days?
Yeah, thanks for the question. Actually, I think that it's let me start with coming back to one of those previous comments regarding the very fat tails of the credit distributions. Because of the fat tails, the law of large numbers works very slowly for credit portfolios and even for credit indices. So ultimately, if you try to forecast, which unfortunately the job of risk managers is try to forecast or estimate what the risk is, you always take whatever your system gets you and gives you and multiply it by a number between 2 or 4, and only then you arrive at something that can be probably realistic. From that perspective, liquidity is another factor which could exacerbate market moves in credit. On the side of regulation and on the side of new market developments, we definitely have a lot of new developments on the credit ETFs, where liquidity, intraday liquidity, is provided in a pool of assets, which ultimately the underlying liquidity of the assets themselves does not support daily liquidity. It is a liquidity mismatch, very much the same as we had as a primary source, what I believe, a primary source of the 2008
the mismatch between the ETF and the constituents.
The ETF and the underlying assets.
The underlying asset liquidity.
That's right. We had, in 2008, we had money market funds which invested in highly rated securities, which turned out not to be liquid. Liquidity mismatch is ultimately the biggest enemy of financial markets. That's how I see it. On the side of regulation, we do have Solvency II, which came into life this year. We will not know, insurance firms will not really know whether they're compliant or not complying with the regulation until they get their financial statements audited at the end of the year, and they get their returns audited, and they get regulators review their returns. But the penalty for holding credit is quite high. So on the side of demand, there is less demand from insurance firms. I'm sure that there will be some adjustments, and there will be over time not so much replenishment of their credit holdings as one might have expected had Solvency II been a little bit more relaxed about credit.
Is it more conservative also using internal models, or in general is the standardized approach, which is very conservative?
The standardized approach is conservative, okay, but also internal models will be compared by the regulators against standard models.
Let's talk a little bit about liquidity. It's the most, I don't know if Steve agrees with this or not, but it's probably the area in risk management that academics have struggled with and have not really pinned it all down. I have a colleague at NYU Stern who's considered to be one of the leading researchers in this area, but when it comes to insights into the current liquidity situation in credit markets, I don't think it has added that much. And here's some of the reasons. I talked about liquidity as to companies' ability to finance their operations, even if they're very risky companies, triple Cs in particular. That's one measure. Another measure is the liquidity among market makers, the banks and traders who have to trade the securities for investors. And we all know that that's at record low levels in terms of inventories of market makers being essentially very, very costly to hold because of bank regulation. So we have very little inventory from market makers, which means that when there's some sort of shock to the system and risky debt is no longer attractive to hold, everybody's going to run to the exits at the same time, and the market makers won't be able to keep the prices from free fall. Now, the answer to that risk concern, I've heard, is the fact that, well, it's not so bad today because there are new investors in the risky debt market that weren't there before. This time it's different. And as a result, there will be more potential buyers of the debt when someone wants to sell because they view it, maybe the asset managers, hedge funds, shadow bankers are in the picture today buying high-yield debt that were not in the picture in the last crisis. So that is the argument that things will not be so bad if there is a somewhat of a catalyst to a negative shock. I'm not convinced that the shadow bankers or the hedge funds will be there to provide the liquidity when there's a sell-off in the market, because they're going to be also selling.
Absolutely.
And the question is whether or not that's a good argument for the fact that liquidity now is lower among primary market makers. So I'm concerned about liquidity from that standpoint. But that's a kind of speculation as opposed to what we observe about corporates being able to raise funds. That's much more tangible. So it makes it so difficult. But we do know that when spreads jumped to 2,100 basis points in 2008, that reflected liquidity far more than default rates, than recovery rates, anything. That was strictly a liquidity spike or lack of liquidity that caused the problem. So that, I guess, also motivated Basel III to add a liquidity component to the required capital. So now I have to ask the banks of the world and the regulators, will Basel III and the liquidity requirement reduce dramatically the risk of bank failures in the future when there is another catalyst to a financial crisis?
I think Steve wanted to make some comment to
just
liquidity point.
Two comments on liquidity. I mean, you said that academics have struggled with this, and I completely agree. The one thing that is kind of quite striking, though, is that when you look at the different liquidity measures that people have come up with, and there are quite a number now, they tend to move in a very, very similar way.
All of them.
Right? So things measured in treasury markets, things measured in equity markets, they tend to actually do the same thing, even though the kind of underlying data is really very, very, very different. So measuring liquidity and measuring shocks to liquidity, I think there's sort of been a good bit of progress. Trying to kind of explain in some structural way the kind of determinants of liquidity is very challenging.
Yeah.
The issue of sort of market liquidity and market making capacity, I think, is a real worry. Inventories, as Ed said, are sort of are way down. Liquidity in individual bond issues is very poor, and to a large extent, this seems to be due to changes in regulation that makes it sort of quite expensive for banks in particular to engage in this, and it's difficult to believe that regulation is going to kind of row back on that anytime soon. And you know, the one thing I would say, and I had a very interesting talk about this about a week ago, is that I think there is room for sort of innovation in market structure in a lot of these instruments. So all this is traded for largely over the counter at the moment. You know, I think there is room for the development of platforms which would give a lot more pre-trade transparency, and you know, whilst market makers are kind of on the sidelines to some extent, I think it would be a really good thing if we had some development of sort of other trading platforms for these.
That's a good point, because the bond market is still one of the few over-the-counter asset classes still, right? So despite that,
I mean, absolutely, and some sort of order matching, so to do away with the role of the market maker would help.
MiFID was going to address this issue.
That would help a lot. But if you're going to, sorry to keep harping on about central banks all the time, but if you're going to point to one thing why the credit market liquidity bond market has gone so much, it's because of the higher capital regulation. Exactly. You know, I've fundamental review. The trading book kills liquidity 100%. 3-4 times more capital. It's just not. It's not longer viable. Very good point from Professor Altman about, you know, the end investors, the shadow banks, the hedge funds. They're not going to provide liquidity. They'll be the same direction. So, and again, it's a paradox of introducing regulation to strengthen financial markets. That one possibly unforeseen or unintended, but maybe not, consequence is that you weaken financial markets considerably because liquidity goes out of the system. And of course, at the next crash, it's a bit like generals fighting the last war, regulators fighting the last crash. The next crash will be in different form, but if liquidity dries up, then you still get the same, you know, capital doesn't help you if you can't trade out of a position. And if it's a big enough position, think LTCM from 1998, you know, you can still have a systemic effect. So I agree with Professor Schaefer about, you know, I don't see unwinding of FRTB, Fundamental Review of the Trading Book requirements, anytime soon, but it is something that has to be considered. Because, you know, there's no point in strengthening bank balance sheets through regulatory capital and weakening it through market liquidity or illiquidity when the next crash comes round. You could be weak just as much there.
So if the current capital regulation is flawed, as it appears from you, there are some issues, right? What are your proposals to it? Anyway? So
I think we're in a really, you know, somebody who's sort of seen Basel I and Basel II and Basel III and whatever.
And 4
it
5.
seems unbelievable that we're going back sort of to Basel I in some respects. You know, that somehow, right, despite the failure, and it really was a failure, right, of Basel II to prevent the kind of the problems that we've seen, that somehow we think that we're going back to a simple leverage ratio is going to somehow solve the problem. I mean, this is sort of just, but I think there is a real problem here, and the kind of failure, I think what we've seen is a kind of a failure of sort of science in some way. The move from the earlier versions of Basel to something which is much more risk sensitive, on the face of it, made a great deal of sense. But at the end of the day, it was too complicated for regulators kind of to keep a grip on things, okay? Now, whose fault is that? Is it the regulator's fault? Is it the bank's fault? Long debate we could have about that, yeah. But it's been a failure, and I think it's a very expensive failure.
It's not
because the kind of a solution which has been proposed, for example, is that we can't cope with complexity in regulation, so let's just crank up the capital requirements to some point where we just don't have to worry anymore. Yeah. Okay? 15%, 20%, then we won't worry. Do what you like.
The so-called floors, right? The floors, the minimum floors and whatever.
Yeah.
Well, let's be fair. I agree with you that Basel II didn't work, but one of the reasons it didn't work is that the securities that failed were rated AAA and AA when they came out, and so the capital requirements were very low on them. And when they were dropped to CCC and D, it was too late. So it didn't work, but it was because a lot of those securities were rated too high, and the banks ate their own or drank their own juice. I guess that's what the word
they calculated. That's exactly it. There was the securities, but also the failure was the internal models allowed them to have much lower lower capital.
Yeah.
So
they play
it
with
isn't necessary.
That's right.
So that was the failure as well, and they came at just at the wrong time.
Yeah,
Just at the time when you have foundation or advanced IRB, so you can have a lot less actual loss-absorbing capital, and around the corner there's a bank crash, so it came in exactly the wrong time. So it failed for that reason, and also because the internal models enable them to get away with much lower. It isn't necessarily, I like your expression, a failure of science, and it is, it's a failure of financial science. It's not necessarily a bad thing to wind back the clock to a more standardized approach, because at least we can get away from this gaming of the system, and at least we'll be able to compare banks a bit more. Every bank's internal model is slightly bit different in terms of parameters and assumptions and the statistical inputs, the historical data. So I can't compare banks anymore anyway. So if I'm an investor, take a fund manager, I'm looking at banks, I can't compare their numbers anymore because they're all based on slightly different parameters and inputs. So it's not necessarily too bad if we wind back the clock to something that's a bit more standardized. But of course, the downside of that is, yes, you end up with a very high red cap. You say, oh, well, we'll just make it 20% so that everyone will be okay. So we need a good middle ground, which would be nice.
I think we have still 10 minutes in a way. It will be a great opportunity to open up the floors. 2 questions.
I thought we go to noon.
To noon? Yeah, we can go to...
Or midnight.
Yeah, that's fine. Midnight.
Nothing else is happening in the world. We might as well stay here.
So if the next 10 minutes, so let's open up the floors and 2 questions. I think you have a great opportunity to ask whatever you want, particularly to add, right? Yeah. Any question on the U.S. elections? Particularly, in a way, I have a specific view. I think, in a way, this morning when I woke up, and I think that there was a big unknown, and now we have a huge known. So, and this is, in a way, a matter of fact. And I see economically there could be potentially, you're going to see the dollar to strengthen. So
how much has gold gone up?
Gold gone up as well.
Martini, you mentioned gold.
How
much has it, anybody know what's happened to gold today?
Yeah, it went up. It went up by,
I assume, but
yeah.
How much?
It was up about 3%,
3%,
but I think it sold off since then.
It sold off, yeah, we expect that. Let me pose a question, then the audience maybe get involved as well. And 1 or 2 people asked me this, but they had to leave, so I'm speaking for them as well. And I kind of talked around it earlier. What could be the catalyst to another spike in default rates, et cetera, and maybe even motivating another financial crisis? What could be, and of course, when it comes to catalysts, if we know about it and quantify it, it should be priced into the market, so it's usually something that we don't know about that causes it. But having said that, what could we talk about the risk drivers, if you will?
Yep.
There are 2 ways of looking at risk drivers. One is what could cause an increase or decrease in risk dramatically, and another is new techniques for credit risk. What is coming on the scene that wasn't there before in terms of metrics, models, et cetera? So if we could talk about that. We had a good discussion about
in San Francisco,
fintech in San Francisco. That might be interesting.
Big data and this kind of stuff. So I think,
so maybe the other panelists have some ideas on, and I'll present mine on catalysts.
Any view on this evolution of new credit analytics techniques and big data? Is it something useful in a way that can improve the situation? Or what would you think about Murad in a way?
I don't see anything groundbreaking on the horizon just yet. Even if one of the panelists had a comment about investors being they follow a herd mentality anyway. That's not an insult. I just mean we go in groups, and so at the end of the day, you have an objective to make a certain yield, and if the the conditions drive you to greater risk-reward profile, then so be it. No matter how you are crunching the numbers, doing the analytics, trying to figure out, where the value is, you still have to make the decision to commit to more risky risky assets. So I don't see anything groundbreaking on that.
So you're saying essentially the judgmental aspect of the
ultimately,
risk
yes.
management ultimately is
For-
going
for-
to become more important?
Well, I think ultimately it'll always be there required. For the institutions that make a difference, the systemic institutions, one can point to, computerized trading, algorithmic, but when you're looking at the people who are holding all our cash, the pension funds, the insurance companies, the banks, ultimately it's a judgment call. And I think if they go through the black box approach, it's not necessarily a solution. We've already had comments about a failure of science about, finance isn't physics. If I wanted to place a lander on a comet 300 million miles away, flying at 50,000 miles an hour, I can use physics and do it just right. Whereas I can't get it, the models will be flawed. I think there's a quote from your paper, isn't it, Christiane, about all models are flawed, but some are more useful than others.
Yeah,
That's fine, let's go for the useful ones, but ultimately the judgment is still required.
It's George Box's quote anyway, so
Yeah,
I quoted him. George Box.
You quoted him, yes, but it was in your paper.
76, it was my paper, but I quoted him anyway.
Okay, I read it in your
All
paper.
models are wrong, some models are useful. Right?
Yeah,
So,
absolutely.
Which
But it's still ultimately a judgment call, isn't it? So
Yeah.
I didn't see anything groundbreaking arising out of this, but could be wrong.
what's your view, Piotr?
On the subject of fintech, I think I might agree with Murad. I think that if we step one step away from this and the hope or perhaps the impact of technology, we've had this huge increase of productivity due to internet and new technologies that became available. Since then, there has been a lot of talk about the natural rate of growth slowing down and having slowed down in all developed economies and actually even slowing down in the emerging economies. It might be that artificial intelligence will be this next step to increase productivity. If it is, then we might be talking about growth with potentially less risk. And if we do have growth, economic growth with less risk, this will improve liquidity. My view is that ultimately liquidity in the asset markets is a derivative of growth.
So you see these techniques more having an impact on the operational efficiencies of the
corporates,
process,
of
more
corporations.
than on the risk side. Is the
Yes.
judgmental dimension still relevant in a way in your risk assessment? Because
Definitely it is, yes. And you get it wrong sometimes, you get it right sometimes. When you get it wrong, you hope you're too conservative.
and
With
this is the same
respect-
comment we got from the chief risk officer.
By the way, the current buzzword, of course, is fintech, and there's been a lot of activity in that area. We used to call, and it revolves around the concept of big data. By the way, we used to call that data mining. That was a negative term. Then somebody thought of big data, same thing, and now it's a positive term. So marketing of terminology is quite interesting. But having said that, I think you're going to find, and we're already experimenting with it at NYU, a huge increase in courses under this rubric called FinTech. We are, in September of this coming year, introducing I wouldn't call it a degree, although I'm sure that will happen. We're calling it a concentration in FinTech for our students. And we already have 11 courses on the books that could be chosen by the students that are related to that. Some of them are finance courses, some are operations management courses, some are information technology courses, but there is a big increase of faculty interested in this area, and a pretty easy area to get publications in because there's very little out there. And so people are beginning to write in this area if they view that as helpful for their careers. Having said that, the question is, will that impact credit markets, which is, I think, the question that was posed. And the way I look at it, and I'm sure it's just the beginning and other people are looking at it too, I think the area of, let's just say, non-traditional data, social media data, big data, is going to impact first consumer credit. Maybe the next stage will be small and medium-sized firms. And the last stage is probably going to be large firms and sovereigns. So I say that's the progression. Already you have companies starting up in the consumer area to provide new types of metrics for establishing creditworthiness or enhancing creditworthiness models. I think it's going to then spread to, and we're actually looking at this in the SME sector, small and medium-sized firm. I haven't seen it at all in the large firm analysis. Maybe I'm missing something, and it is there, nor in the sovereign, except for the sovereigns. Can we somehow quantify the impact of a Donald Trump victory on sovereign risk, or is it some underlying variables that's more important than the election results that cause the election results, such as protectionism and the like? I think this is really fruitful for new research and experimentation, and it's going to be, I think, very interesting to watch this fintech revolution and what new models come on.
It's definitely an area of innovation in credit risk for sure. Martina,
Thank you.
a question?
Is that on?
Yeah, is it on? Yeah.
I actually, not to hog the microphone, but I did have two questions. One was a segue from the concept of fintech. So I agree with you in terms of the ability to measure probability of default for corporate or institutions, very different from payment behavior based on your social media activity and things like that. I think it's more likely to come in structural innovation in the markets, and I was curious to hear a little bit more, Stephen, about your comment earlier about innovation in market structure. So that was one question. The other question was a question for Peter on we've heard a lot as well about the cash that's being held on the buy side, whether it's pension funds, insurance companies, and you talked about how expensive it's getting to hold credit. Where does the money go? I'm just curious to hear what you're thinking about in terms of the interesting asset classes.
Steve?
Yes, so maybe I can bring these two things together a little
Steve,
bit.
could you repeat the question you're going to answer?
The innovation in market structure, particularly.
Yes.
Market structure?
Innovation in market structure.
Okay.
Yeah, and maybe I can link that a little bit to fintech as well, in a way. And that, for those, I imagine a lot of people here know about the trace data, right? So if any of you looked at that in any detail, you'll know that it has very it has some strange features for what should be you would hope an efficient market. So the same bond trades very often at completely different prices, okay? Particularly for small trades and big trades, basically small investors end up sort of paying prices that can be an awful long way away from what the prices that institutional investors pay. So this is the result of sort of very poor, in particular, pre-trade transparency. And it wouldn't be beyond the wit of man to basically have a kind of a sort of a matching system, a crossing system, some platform that basically does away with that, all right? Is that sort of fintech? No, it's probably bigger scale than kind of some typical fintech, but it is a kind of, it would be a disruptor, okay, to the existing system, which is largely market maker based.
So you're calling for electronification, essentially, of the bond market, right?
And the kind of, interestingly, the thing that gives an opportunity to this kind of activity is a regulatory intervention that has suddenly made the traditional way of doing things that are rather expensive and ineffective. And I think just generally, just general comment about this, about sort of fintech, there's an awful lot of stuff going on. Some of these things are undoubtedly doomed to failure, but I think there is a real challenge for incumbents, in particular I would say banks, okay, who have sort of cost structures that are actually wedded to particular kinds of technologies. Yeah.
It's interesting. I think the final, where we are perfectly on time, the final answer, where does the money go, right, Martina? You want to know where does the money go? It's interesting.
I don't know where the money goes. Nobody really knows where the money goes. I don't think there is as much money going into cash as we're being led to believe. I think that ultimately Yes, people are saving more, but the population is aging, and there is more consumption coming up, and there will be more consumption coming up as opposed to savings. This is demographics, but it's also low growth. I think that those two factors ultimately mean that pension funds still hold bonds and equities. Insurance firms still hold bonds and equities. If they were to reallocate to cash, that would be the end of the financial world as we know it. So they will keep holding bonds and equities ultimately. Even if cash rates are low, they will hold some cash for liquidity purposes. And I think this is ultimately the cost of low interest rates, is that the liquid part is actually a cost now.
Yeah.
Investors are really looking, across the asset management industry are really looking for low cost alternatives also. There is a lot of talk and a lot of investments in the alternative risk premia. There is a lot of talk about risk parity, but investors, institutional investors, whenever they look at it, they look at low cost options. So there is a trade-off here too.
That's a great point. I think. Thanks very much for sharing your views on behalf of our company. Thanks again.